Augusta here from the New Face of Finance. One of the most watched videos on my mortgage series discusses shared ownership, otherwise known as share to buy. So I thought that I would take the time to do an extended video around this topic. I noticed that in February 2020, controversial property investor Samuel Leeds made a video denouncing shared ownership. And it's a very short video, and I think that it fails to take into consideration so many aspects. So I thought that I would make an extended video and really talk to you in some depth about shared ownership. And the angle I'm going to take it from is being an award-winning mortgage advisor, but I'm also going to take it from the angle of being a property investor and developer. I get it. Samuel Leeds is providing his limited perspective from a property investor's point of view. I disagree with him though. I believe that understood and used properly, shared ownership is an incredible tool to get started in property. What I'm going to do today is break down some of the pros, but also some of the cons in a lot more detail, so that you can make an informed decision about whether it's right for you. We'll start with the pros. If you don't earn over £100,000 a year or have a 40% deposit, and you want to get on the property ladder in London, so maybe you work and choose to live in and around London, there aren't that many options that are viable to you. The average one-bed flat in London is arguably £450,000. Lenders will lend about 4.5 times your income. Some lenders say 4 times, some lenders will say 5.5 times. But to get the widest scope of the market, and once usually run it through affordability, we're usually looking about 4.5 times income. Pre-COVID, the market was competitive at around 90% loan to value, which meant that on a residential purchase, especially if it was your first purchase, you could, subject to affordability, put down a 10% deposit and get a mortgage on the remainder. However, COVID has made the market a lot more conservative, and 10% barely exists. It is so hard to get a 90% loan to value mortgage. At the moment, where is competitive? Where are lenders feeling comfortable? 85% loan to value, which means that you have to find a 15% deposit. Let's expand our example. £450,000 one-bed flat in London, you have to put down 15%, which is £67,500. Once you've raised your deposit, then you'd be looking for a mortgage. In this instance, that is £382,500. And to achieve that mortgage at 4.5 times income, you need to be earning £85,000 per annum. If employed. If self-employed, your last 2 years filed tax returns should come to that value, and also there should be no background unsecured debt, because that will have an impact on your affordability. Shared ownership allows you to purchase between 25% and 75% of the property on day one. According to findcourses.co.uk, the average UK salary now stands at £36,611 per year if you're working full time. At 4.5 times income, that permits you to buy approximately a 35% share of your £450,000 one-bed flat in London. In that instance, your share value would be £157,500. The average lender, and usually the housing association, would require a minimum 5% deposit. And in this example, that would equate to £7,875. Therefore, the mortgage that you would request would be in the region of £149,625. So you would buy 35% share, and then you would be paying rent to the housing association for the 65% of the property that you don't own. Rent and your other living costs would also be factored into affordability. Samuel Leeds argues that one of the reasons shared ownership is bad is because you cannot rent out the property. He's correct. This is not a strategy if your plan is to rent out the property that you live in. However, as a broker, I can tell you that it's not that easy to go straight into buy-to-let investing anyway. There aren't that many lenders who are willing to give you a buy-to-let mortgage if you do not have a residential mortgage. Shared ownership allows you to get out into your own space. Yes, it's a property that you would have to live in, but you do automatically become a homeowner. You find yourself on the property ladder. This example, you can be in for less than £10,000 of deposit. And once you've completed on your shared ownership property, because you're considered a homeowner, it's then easier for you to get a buy-to-let mortgage. The transition is much more seamless. What if you want to sell? Samuel Leeds states that, well, no one will want it. That's not really true. The reality is that the housing association, who are the body that are the freeholders and the people that are offering you the property, they will get first refusal. So if they want to buy it back from you, they can. And how do they decide what they're going to pay for it? They will pay for an independent valuer to come out and survey the property and provide it with a market value. However, if they decide that they do not want to purchase it, then what you will do is approach an estate agent who specializes in shared ownership properties. And therefore, you're only marketing it to people who are interested in this aspect of the market. Provided your property is kept in good condition, there is always the possibility of resale. Now, without a thought-through plan in place, your only credible exit is sale of your share. However, several of my clients have successfully staircased. Staircasing means purchasing a higher share of the property. So you can go from 25 or 35% up to 50% or even up to 100% and buy out the housing association owning the flat. It's important to note that each housing association has varying scales. So some will go up 25%, 50%, 75%, and some will have smaller increments, so 40% or 55%. It's up to you to do your research and ask the questions. Let's go back to the example we were using. So you saw this flat in London for £450,000. Your affordability permitted it, so you purchased 35% of it. You have fixed the mortgage for 5 years. Fast forward 5 years' time, a few things have happened now. Firstly, the property has gone up in value. So not just your share, but the property as a whole has increased. Secondly, you're doing better at work. So you earn more money than you did 5 years ago. And on top of that, you are now in a long-term relationship where you are married and you can add your spouse's income to the equation. And thirdly, over the course of this 5 years, you have been paying down your residential repayment mortgage, that 35% share. So now there is more equity in the property than when you first purchased it. Okay, now follow me with this, because it might seem complicated, or it's going to begin to sound complicated. But don't worry, I'm going to illustrate all of this in a diagram for you to study and think about. So now let's say your apartment, which you purchased 5 years ago for £450,000, has now gone up. And the whole apartment is now worth £550,000. It's gone up by a whole £100,000. When you purchased that property, you purchased a 35% share. And so the value of that share the day you purchased it was £157,500. Now the value of your share is £192,500. But you've been very clever and you've been super proactive, and you have taken out a mortgage that has allowed you to overpay. So where your original mortgage was £149,625, you have managed to pay it down to £85,000 over that 5-year period. So now you only have £85,000 remaining on your mortgage. And you want to think, okay, I want to purchase more of the property because I earn more. How much more can I purchase? Now let's imagine a scenario where you were earning an average income of £36,611 5 years ago when you purchased a property, and you were in IT, in information technology. And that is a decent salary and a pretty average salary for someone who's starting out in that industry. 5 years later, you have become a specialist in your field, and you've decided that actually you're good enough, I want to risk becoming an IT contractor. Your average contract pays you £400 a day. Now there is a market out there exclusively for people who are in this particular scenario. At £400 a day, the lender will lend to you based on your day rate, provided that you have been contracting for 12 months or more. And every lender will use a slightly different calculation, but to encompass the whole market, let's assume that they're going to use your day rate because you work 5 days a week, multiplied by 5, and you work on average about 46 weeks of the year. In this scenario, they would deem your income to be £92,000 a year. Your spouse earns a more modest income at £25,000 a year. But combined, your joint household income is £117,000 a year. You have also been very good and managed to keep debt levels very low. At 4.5 times your income, your potential borrowing capacity is £526,500. Now this is important. What it does suggest at first glance is that actually you have the affordability to purchase this whole property. But we have to take a closer look at how these figures would work. So right now you owe £85,000 on your mortgage. The remaining 65% of the property, when you purchased it 5 years ago, it was valued at £292,500. However, today, because the property has gone up from £450,000 to £550,000, that share, that 65%, is now valued at £357,500. So yes, unfortunately, if you bought it 5 years ago, you could have bought it at £292,500. But today, to buy the same share, you must find £357,500. However, you don't have to find this cash, and subject to affordability, you can mortgage this amount. So the amount that you're looking to borrow is £357,500 plus the £85,000 that you still owe on the share that you own. Combined, this would be a loan of £412,500. So on one hand, your household income on affordability is £526,500. And on the other hand, in order for you to purchase the whole property, you need a mortgage of £412,500. You can afford to purchase this whole property. Now, provided that on completion, you do not need a mortgage of more than 85%. Remember, I'm telling you that in this current market, 85% is the new norm. Provided you do not need more than an 85% loan-to-value mortgage, pretty much the whole market is willing to give you a mortgage to purchase this property. Yes, you don't have to put down a deposit. They will allow you to take an 85% loan-to-value mortgage to buy out the housing association. 85% of £550,000 is £467,500. You only need a mortgage of £412,500. So you can see in this particular example, because you put a plan in place, because you've been disciplined, and because you've let the natural order of events take place, you have been able to purchase your full shared ownership property. Now, this might seem far-fetched to you, but I have seen something similar to this, or something encompassing a combination of all these factors take place at least 5 times in my career. I testify that it is completely feasible. As you can see, loads of pros. Now we're going to move on to the cons. It's true, as Samuel Leeds pointed out, if your desire is just to get started in buy-to-let immediately, this isn't a great option for you. It's also true that most housing association properties are flats. They're leasehold properties, which means that there probably will be an element of ground rent and service charge. And it means that even when you own the whole flat, you will always have a freeholder. And when your lease drops below a certain amount, typically 75 years, you will have to pay a fee to the freeholder to increase that lease. However, this doesn't just apply to shared ownership properties. This is the same with any purchase of flats. Your conveyancing costs, which are the legal costs associated with purchasing the property, and you will pay these legal costs on any property transaction. They tend to be higher with shared ownership properties than with standard purchases. So perhaps the typical conveyancing costs, including fees and disbursements, would be $1,200, $1,250. You would be typically looking to pay $1,700 or $1,750 in a shared ownership transaction. Believe it or not, mortgage lenders tend to be more chilled out than the housing association when it comes to affordability. On at least 2 occasions, I have been able to deliver a mortgage offer. The housing association has looked at it, plugged it into their affordability calculator and decided that they deem it unaffordable. Because of this, I've learnt my lesson. And prior to even putting a mortgage in place, I would normally ask my applicant, my client, to provide the affordability calculator that the housing association is going to use. And I would ensure that any mortgage that I'm going to recommend will fit on their affordability. It is very important to ask the right questions up front, like what is the stages of staircasing that is allowed with this particular housing association? Another important question is, what is the minimum required deposit? There are lenders on the market who will provide you with a 100% mortgage for the purchase of your share. So if we go back to our example of where you were purchasing the 35% of the £450,000 property, there are mortgage lenders that will allow you to purchase that 35% share without a deposit. Subject to affordability, they will give you 100% mortgage against the value of that share. However, on at least 1 occasion, I have managed to do this. We've taken it to the housing association and they have said, no, we require a minimum of a 5% deposit. So it's really important, before you begin the mortgage process, that you ask pertinent questions about what is and what isn't acceptable. Every housing association has a slightly different criteria. It's generally accepted that if you have a household income of £80,000 or more, you won't be accepted onto the shared ownership program. And this is usually £90,000 in the London area. So it's really important that you check through the terms and conditions and check your eligibility before you proceed with any given housing association or shared ownership application. If you apply for a shared ownership property as a single person, it is difficult to purchase more than a 1-bed property. Usually because there is a slight disconnect between supply and demand, being that there is a higher demand for shared ownership properties than are actually on the market. It means that the 2-bed and the 3-bed housing association properties are usually reserved for couples and families. You won't find this with standard purchases. You may need to ask the freeholder, who is likely to be the housing association, for certain permissions before you can make changes to the property, such as paint a wall or put up a shelf. Also, because shared ownership properties tend to be new builds, there is usually a new build premium, which means that you pay slightly above market value for the privilege of being the first person to ever have lived in this property. If you buy a shared ownership resale property, you're less likely to be stung by this. Another concern with housing association properties is the risk of negative equity. But I do think that people need to understand this a bit more. So let's go back to your example where we purchased 35% of this property that was valued at £450,000. If in 5 years' time, the property is actually now worth £400,000 as opposed to £550,000, yes, you are experiencing negative equity on the 35% that you own. However, depending on your view of the market, and property is a long-term game, there is an argument, it is readily accepted that property values, particularly in the South, double every 7 to 10 years. So you might view this reduction in the property value as an opportunity for you to buy the remaining 65% at a much lower or cheaper rate than you would have done previously. So that concludes my analysis on shared ownership, or share to buy as it is sometimes known as. As I say, I think that when treated correctly, when planned out well, and when it fits your particular circumstances, shared ownership is a fantastic way to get started in the market, but it is not for everyone. The best thing to do is to understand your personal circumstances, do some research, and seek advice before making a decision about the best way to move forward. Thank you for watching. It's been a pleasure as always. Please do not forget to like, subscribe and comment. Let me know if there's any questions or other areas that you would like me to explore. I'll see you on the next video.